Hello, welcome back. Now, so continuing with the P ratio and the growth rate, right? Um, the P ratio for firm growing at long run steady, sustainable pace, right, will have uh, meaning, G is relatively constant. That means, right? Uh, that means G is relatively constant, right? Then what affects um, uh, the it, the growth rate, of course, depends on the plowback ratio, and the higher the plowback ratio, the higher the growth rate, and the higher the plowback ratio, the higher uh, the P ratio, and the higher the price, the higher the P ratio. Excuse me. Uh, well, that's just the due to the mathematical construct of it. It's just very straightforward, right? Let me just get rid of that. It's only natural. Now, there are, if you look at this, price formula, right? If you look at this price formula, or even look at this, price earnings ratio formula, right? There are, uh, you know, uh, three variables that determine, or four variables that determine the price, right? If you're talking about price earnings ratio, three variables, which are, most importantly, uh, discount rate or cost of capital, right? Now, the question is, if the growth rate is, if the growth rate has to be, uh, if the growth rate is greater than K, I mean, our situation, if you think about it, this is the higher the B, the higher the growth rate. But then you don't want to have a growth rate. I mean, it has to be um, mathematically less than the required return, and this will and this cannot happen, but this will be a problem. I mean, think about it. Can this happen? Can this happen? No, it can't happen. First of all, if it happens, that means uh, the denominator is negative, and if the denominator is negative, the whole fraction will be negative. So mathematically, this shouldn't happen. I mean, cannot happen. Another reason it cannot happen is, think about it. If the growth rate is high, right? If the growth rate goes up, can the growth can you still can the required return be still at the same level? Hmm? No, it cannot. It has to go up too. It has to go up by more than In other words, if that's the case, the change in K must be greater than change in G. I mean, the growth in the required return must be greater than the growth in the increase in the growth rate. Why? Think about it. If the company is growing at a fast rate, the risk, it is perceived to be a risky company. Risky in the sense, oh, if it is growing at a fast rate, why is it risky? Oh, fast growth also, comes with, wide swing in earnings, wide swing, right? So they will demand higher return. So the higher return, right? So the change in cost of capital or the required return will be greater than the change in growth rate. So it will always end up in this situation. It will always end up, in greater required return than the growth rate. So that means, also ROE has to be, usually, the if ROE is greater than cost of capital, what does that mean? That means, ROE, it doesn't have to be, but, generally they want the ROE. Generally, they are perceived to be roughly equivalent. This symbol is hard to write. Okay. Generally, this is the case. But if ROE is, and that means if and only if, right? If and only if higher plowback ratio will result in higher price earnings ratio, and the main reason is because, think about it, if ROE is high, if it goes up, right? What's going to happen? What is the reason? If ROE is high, the previous, of course, the previous, previous earnings was high. In other words, E0 and consecutively E -1 and previous periods, earnings were high. So here's an important concept. Probably we in Finance 100, this was also discussed. Price earnings growth ratio was also discussed. Why? Because there are two camps, and so is high price earnings ratio good or low price earnings ratio good? This question, this was discussed in already in Finance 100, so I don't want to make it a big deal, but there are two camps, right? There are two camps in academia. One, uh, the camp that is, uh, the camp that is uh, championing high price earnings ratio. In other words, high price earnings ratio is good. Why? Because um, there's growth potential, right? High price earnings ratio means high growth potential. So where was we? Well, what that we were talking about that because it means high growth potential. But then, if you think about it, flip. If you flip it around, what does that mean? Uh, if you flip it around, that's called earnings yield, right? It's called earnings yield. I probably mentioned this before. Now, so they are reciprocals of each other, right? If you raise this to -1, right? Then it's earnings price ratio or earnings yield. So think about it. Um, would you like, if this goes up, that means this goes down, and vice versa. If this goes up, or what I'm saying is, um, versus price earnings ratio. Now think about it. High price earnings ratio means what? If this is high, then this will have to be low, right? If this is high, then it has to be right low. And if this is low, then this is high. Now think about it. Which one would you prefer? High price earnings ratio or low price earnings ratio? I would prefer low price earnings ratio. Why? Because low price earnings ratio means high earnings yield. That means for the same price, you get more earnings. Earnings per share is greater for the same price. Make sense? On the other hand, high price earnings ratio means for the same price, earnings are smaller. Earnings per share is smaller. So obviously, by any common sense, low price earnings ratio is more should be preferred, right? But what did you learn? From the previous uh, if the price is high, of course, then there will be high price earnings ratio, but that means present value of growth opportunity. It's all high price earnings ratio is due to present value of growth opportunity. But again, growth opportunity is, in other words, growth potential, and growth potential is actually nothing but a fluff. Isn't it right? It's nothing but fluff. If it gets realized, then it is a good thing. But otherwise, it's a fluff, right? So actually, there are two camps in the one camp champions high price earnings ratio. The other camp champions low price earnings ratio. And the head of this, low price earnings ratio camp is none other than Warren Buffett, right? Warren Buffett has been hunting for high earnings yield or low price earnings ratio stocks. Why? Because it's obvious, over and over, he calls it, value investing. And this is, what he, in his, 1980, 1984, I believe, 1984 paper or speech, later put into paper. Uh, Super investors of Graham and Doddsville. That was a very famous, and it's basically why Graham and Doddsville. Graham and Dodds were his professors when he went to Columbia in the 1950s, and those, Graham and Dodds were um, stressing, really emphasizing that, value investing, low price hunt for low price earnings ratio. Now then, our question is, and the other camp, the proponents of the high price earnings ratio, right? And Warren Buffett is the head of the proponents of the low price earnings ratio. Which one is right? Well, both are are right, but there's a catch here. Why? How do you know? I mean, how do you know if it is high price earnings ratio? I mean, there's a good reason why. They are saying if the stock is giving you very good earnings, right? Very good return, very good earnings. Uh, why is the price still low, right? I mean, if the price is giving you a good earnings per share, then the price will be driven up because the market will soon notice such stock, and then everyone will want to jump into the bandwagon. So it will drive up the price. It won't be maintained. That low price earnings ratio won't be maintained for long. It will soon turn into high price earnings ratio, right? That's what they are saying. Uh, True. I mean, think about it. Uh, but then low price earnings ratio cannot last very long. So what Warren Buffett is saying is, uh, there is a very limited window. The window won't last very long. I mean, if you find any low price earnings ratio stock, obviously that's an undervalued stock, undervalued, right? Um, so before the rest of the market catches on with this, right? Sooner or later, the market will catch up, right? So while the window is still open, while the price earnings ratio is low, you have to hold it. You have to buy the stock, right? But again, even so, high price earnings ratio stock would be something that would be, in demand. Clearly, it's an evidence of that strong demand. And then question is, whether this is going to be a success, whether it's going to take off, or it's nothing but a fluff, right? And it will, the bubble, it's full of bubble, whether it's going to be a full of bubble and the bubble's going to burst. Um, of course, if it is the latter, of course you shouldn't put your money into that stock. And how do you know that? Of course, you will have to look, into its financial statements. In other words, fundamental analysis. You'll have to check, its fundamentals, profitability, liquidity, and asset management ratios, and debt management ratios, all that category. But one simple ratio that can easily tell you that is PEG ratio. PEG ratio is actually price earnings ratio over earnings growth rate ratio. Now think about it. If price earnings ratio is 200, that's a very high price earnings ratio, isn't that right? Why? that means the price of the stock is $200, right? But it's paying you only $1 earnings per share. That is ridiculous, right? You paid $200, but I mean, why would that be the case? Well, that means it's overvalued, right? Clearly, it's but um, but for such meager payout, right? For such meager payout of earnings per share, the how can that price be maintained at $200 level so high? I mean, Tesla was like that. Why? Because people, this is all bubble. It could be all bubble. People are just, uh, because of the growth potential, people are still, demanding the stock, even for $1 payout, earnings per share, not payout, earnings per share, they will still, but then if the growth rate is also 200% a year, 200%, right? 200%. Isn't that a wonderful stock? I mean, just in 1 year, 200%, right? Ignore that percentage. I mean, this is just ratio and this is uh, uh, percentage, but ignore that percentage. But if you ignore the percentage, then the ratio will be 1. Isn't it right? The ratio will be 1. What does that mean? What does the ratio mean? Uh, well, it is worth, that high price earnings ratio is not for nothing. It is worth the growth rate because the growth rate is 200%. I mean, um, with such a growth rate, that high price earnings ratio is justified. That's what it means. Okay, that's what it means. Um, so if the PEG ratio is 1, that means uh, the stock is fairly priced or exactly valued. If the PEG ratio is less than 1, it is undervalued. Anything undervalued is a buy target. If the PEG ratio is greater than 1, it is overvalued. Okay. Now that brings us to the. Let's take a look at some of the uh, some experiment, right? So if the required return is 12%, on with that assumption, and is fixed, right? We are given 12% plowback ratio. There are uh, 4 possible plowback ratios: 0 and 25%, 50%, 75%. Well, if any company plows back 75%, wow, that's high growth. So then growth rate. Let's see how growth rates will change under different, and growth rate is what? ROE times B, right? Which is simply ROE times B, right? Oh yeah. Okay. And if you do that, of course it's zero. 10%, 12%, 14% ROE, doesn't matter. When plowback ratio is zero, it's all zero. And then 10%, under 10%, 2.5, 5%, 7.5, 12%, 3, 6, 9, 14%, 3.5, 7, 10.5. But you think, oh, if growth rate is 7%, 9%, they are okay. Uh, think about it. Even at 10.5%, this is still less than still less than right, required return. That's so hard to write. It is still less than, right? Okay, so it's not gonna, nothing's gonna be negative, right? Now, let's think about the P ratio. P ratio is basically, 1 minus plowback ratio over K minus G, right? And our G's are there. So RO is 10% when, and then when plowback ratio is 0, it will be just 1 over 12.12, right? Because K is 12%. And it's going to be, no matter what, at 0%, ROE, at 0% plowback ratio, it's going to be 8.33. P ratio will be like this, and 0.25, 25% plowback ratio. And then the growth rate is, 0.025, right? 2.5%. And if you do that, 7.89, and so on. Try, P ratio would be like this. Yeah, 16.67. If the at 14% ROE, and at 75% plowback ratio. So this is basically showing you the evidence of the correlation between the plowback ratio and P ratio, right? Of course, as plowback goes up, and think about it, as ROE goes up, and as the plowback ratio goes up, G will go up, right? Right? And as G goes up, as G goes up, right, and ROE, plowback ratio goes up. Since this is G, this goes up. Think about it. If this goes up and this goes up, actually, if something is constant, if one of them is constant, right? If, let's say, plowback ratio is constant, and only ROE goes up, and of course, then growth rate will go up, right? And then P ratio will go down if that is the case when B, let's say B is constant, right? Plowback is constant. But if B is going up as well, then it will it will be a variable, right? But but the point is, if the numerator goes down and denominator goes down too, right? So, and if the rate of change, in other words, how much they go down, uh, that rate of change is the same, then there won't be much change in um, price earnings ratio. But if one of them is constant, what I'm saying is, plowback ratio is constant, right? But ROE goes up. Oh, G will go up anyway, but this is constant. And denominator, as G goes up, denominator goes down, right? As G goes up, the whole denominator goes down, right? And then the P ratio will go up. That's the case if the P ratio will go up, and vice versa, right? So, but if they both go up, right, or both change, B goes up, G goes up altogether, the effect will be, which one, changes more. It will depend on which one changes more. So, for this one, there will be more discussion about, there will be an example, and we'll discuss more about this in the next uh, video, right? In the next video. All right. Thank you for watching, and I will see you guys in the next video. Stop recording.